Section 1, the Oracle of Omaha's teacher. Have you heard of Warren Buffett? Of course you have. He's like the rock star of investing. But even rock stars have mentors. Buffett's was Benjamin Graham, the author of Security Analysis. This book is a Wall Street classic. Graham teaches us how to think about investing. He wants us to be smart with our money, not gamble it away. Graham believed in value investing. What's that? It's like finding a hidden gem at a flea market. You're looking for stocks that are worth more than their price. Sounds simple, right? But it takes skill and patience. Section 2, why this book matters. In a world of instant gratification, Graham's book is a breath of fresh air. It's not about getting rich quick, it's about making smart, long-term investments. Graham teaches us to be detectives, not gamblers. We need to investigate companies, understand their worth, and then decide if their stock is a good deal. Think of it like buying a used car. You wouldn't just look at the shiny paint job, right? You'd check the engine, the mileage, the history of the car. Investing is the same. You need to look under the hood of a company before you invest your hard-earned money. Graham's book gives you the tools to do just that. You'll learn how to read financial statements, analyze a company's performance, and determine its intrinsic value. Section 3, laying the foundation. What is value investing? Imagine you're at a discount store and you find a designer jacket for a fraction of its original price. That's value investing in a nutshell. You're buying something for less than it's actually worth. In the stock market, we're looking for undervalued companies. These are businesses that are doing well, but their stock price doesn't reflect their true value. Graham believed in thoroughly analyzing a company before investing. Don't just follow the hype or listen to your buddy's hot stock tip. Dig deep, look at their financial statements, understand their business model, and see how they perform in their industry. Value investors are like detectives. They're looking for clues that others might miss. They're patient and disciplined, willing to wait for the right opportunity. They don't get scared off by short-term market fluctuations. They know that in the long run, value always shines through. Section 4, margin of safety. Your financial cushion. We all make mistakes, right? Well, in investing, mistakes can cost you money. That's where Graham's concept of margin of safety comes in. It's like having a safety net for your investments. Imagine you're building a bridge. You wouldn't just build it to hold the exact weight limit, right? You'd add extra support just in case. That extra support is your margin of safety. In investing, it means buying a stock for significantly less than its intrinsic value. This cushion helps protect you from unforeseen circumstances. Having a margin of safety gives you a buffer, reducing your risk of losing money. Section 5, Mr. Market and you don't be a sucker. Graham introduced the concept of Mr. Market to illustrate how emotions can influence investment decisions. Imagine Mr. Market as a fickle character who shows up at your door every day offering to buy or sell stocks. Some days Mr. Market is overly optimistic, offering ridiculously high prices. Other days he's a grumpy pessimist wanting to sell stocks for dirt cheap. But here's the thing, Mr. Market is driven by emotions, not logic. Graham's advice, don't let Mr. Market dictate your investment decisions. Don't get caught up in the hype or panic. Instead, be a rational investor. Do your research, determine the intrinsic value of a company, and then decide if Mr. Market's offer makes sense. Remember, you don't have to buy or sell just because Mr. Market is in a buying or selling mood. you're in control. Be patient, be disciplined, and wait for the right opportunities. Don't let Mr. Market make a fool of you. Stay focused on your long-term goals. Section 6, unlocking intrinsic value, the heart of value investing. All right, let's talk about intrinsic value. It's a big deal in the world of investing, especially for folks who follow Benjamin Graham's teachings. Think of it like this: every asset, whether it's a company, a house, or even a rare comic book, has an intrinsic value. It's the true worth of that thing, regardless of what the market says it's worth today. Now, figuring out intrinsic value isn't always easy. It takes a bit of detective work, digging into financial statements, understanding the business model, and analyzing future earnings potential. But why does intrinsic value matter so much? Well, because it helps us make smart investment decisions. Section 7, more than numbers. Qualitative factors matter too. Now, before you think intrinsic value is all about crunching numbers and building complex spreadsheets, hold on a second. While financial analysis is crucial, Graham also emphasized the importance of qualitative factors. These are the things that don't show up directly on a balance sheet, but can significantly impact a company's future success. Think about things like the strength of the management team, the company's brand reputation, its competitive advantage in the market, and even the overall industry outlook. These qualitative factors can make or break a company regardless of how good the numbers look. Remember, we're not just buying stocks, we're investing in businesses run by people. So it's essential to assess the jockey as much as the horse. Look for companies with experienced and ethical leadership, a strong track record of innovation, and a clear vision for the future. Section 8, putting it all together. A practical example. Let's say you're considering investing in a company that makes bicycles. You've done your research, looked at their financial statements, and even taken a peek at their competitors. On paper, everything looks pretty good. They have steady revenue growth, a decent profit margin, and a manageable amount of debt. But here's where the real detective work begins. You start digging deeper into their financials and notice that their inventory levels have been steadily increasing over the past few quarters. This could be a red flag, suggesting that their bicycles aren't selling as quickly as they used to. Then you read some industry reports and discover that there's a growing trend of electric bicycles. Section 9, investing versus speculation, knowing the difference. All right, let's talk about the difference between investing and speculation. It's a distinction that Graham felt very strongly about, and it's a key takeaway from security analysis. Think of it like this. Investing is like planting a tree. You carefully choose a healthy sapling, nurture it, and patiently wait for it to grow and bear fruit. Speculation, on the other hand, is more like playing roulette. You are betting on a particular number or color, hoping for a quick win. There's no real analysis or understanding of the underlying asset. It's just a gamble. Graham believed that true investors focus on the long-term performance of a business. They buy stocks and companies with solid fundamentals, understanding that the market may not always reflect their true value in the short term. Speculators, on the other hand, are often driven by short-term market fluctuations, rumors, and emotions. They're chasing quick profits, often without a deep understanding of the companies they're investing in. Section 10, the danger of market timing. Don't play the guessing game. Have you ever heard someone say, I'm waiting for the market to bottom out before I invest. That, my friends, is the siren song of market timing. It's tempting, but oh so dangerous. See, even the most seasoned investors can't consistently predict short-term market movements. It's like trying to catch a falling knife. You're more likely to get hurt than to time it perfectly. Graham believed that trying to time the market is a fool's errand. It's based on speculation and emotion, not on sound investment principles. Instead of trying to predict the unpredictable, he advocated for a more disciplined approach, dollar cost averaging. Section 11, patience and discipline, the value investor's mantra. In a world of instant gratification and get-rich-quick schemes, Graham's emphasis on patience and discipline might seem a bit old-fashioned, but trust me, these qualities are like gold in the world of investing. Remember that tree we talked about earlier? It takes time, care, and patience for it to grow and bear fruit. The same goes for your investments. Graham believed that successful investors are like marathon runners, not sprinters. They're in it for the long haul, willing to weather market storms and resist the urge to make impulsive decisions based on short-term fluctuations. Discipline means sticking to your investment plan even when things get tough. It means not getting caught up in the hype or panic of the market. Section 12, financial statements, your treasure map to value. All right, folks, get ready to dive into the world of financial statements. I know, it might sound as exciting as watching paint dry, but trust me on this one. Financial statements are like treasure maps leading you to a company's hidden gems or warning you of potential pitfalls. We're talking about three main players here: the balance sheet, the income statement, sometimes called the profit and loss statement, and the cash flow statement. Each one tells a different part of the story, giving you a 360-degree view of a company's financial health. Think of it like this. The balance sheet is a snapshot in time, showing you what a company owns, assets, and what it owes, liabilities, at a specific moment. The income statement, on the other hand, is like a movie, showing you how much money a company made, revenue, and how much it spent, expenses, over a period of time. And finally, the cash flow statement tracks the actual cash flowing in and out of a company. Section 13, decoding the balance sheet. Assets, liabilities, and equity. Let's start with the balance sheet, shall we? Remember that snapshot in time we talked about? Well, the balance sheet is divided into two main sides: assets and liabilities plus equity. Think of it like a seesaw. It always needs to be balanced. On one side, we have assets, which are things the company owns that have value. This could include tangible things like buildings, equipment, and inventory, as well as intangible assets like patents, trademarks, and goodwill. On the other side of the seesaw, we have liabilities, which are the company's debts or obligations. This could include things like loans, accounts payable, money owed to suppliers, and deferred revenue, money received for goods or services not yet delivered. And finally, we have equity, which represents the owner's stake in the company. Section 14, profit and loss, unveiling a company's earning power. Let's move on to the income statement, or profit and loss statement. It shows a company's financial performance over time. It's like a report card showing profits or losses. It starts with revenue, the total money earned. Think of it as money from selling goods or services. Next, we subtract the cost of goods sold, COGS. This includes raw materials and direct labor. After COGS, we get gross profit. Subtract operating expenses, interest, and taxes to get net income. This is the profit after all expenses. The income statement helps assess a company's earning power and growth potential. Section 15, Graham's enduring legacy, a timeless approach to investing. So there you have it. We've taken a whirlwind tour through the key concepts of Benjamin Graham's security analysis. It's a dense book packed with wisdom that's as relevant today as it was when it was first published in 1934. Graham's teachings have stood the test of time, influencing generations of investors, including the Oracle of Omaha himself, Warren Buffett. His emphasis on value investing, margin of safety, and disciplined analysis continues to guide investors in navigating the often turbulent waters of the stock market. In a world of high-frequency trading, algorithmic investing, and constant market noise, Graham's principles serve as a beacon of clarity and reason. He reminds us that investing is not about chasing quick profits or trying to time the market. It's about understanding the true value of a business, investing for the long term, and letting patience and discipline be our guiding stars. While the financial landscape has undoubtedly changed since Graham's time, the fundamental principles he laid out in security analysis remain as relevant as ever. His teachings provide a solid foundation for anyone looking to build wealth through intelligent and informed investing. Security analysis as your guide. Think of security analysis as your compass and map in the world of investing. It equips you with the knowledge to navigate the market maze and make informed decisions. Investing is about understanding businesses, analyzing financial statements, and assessing risk. Be a detective, uncover hidden value, and make calculated decisions. Graham's teachings empower you to take control of your financial future. Security analysis is not a get-rich-quick scheme. It involves risk. Embrace Graham's principles to weather market storms and achieve your goals. The journey of 1,000 miles begins with a single step. With security analysis as your guide, you'll achieve financial success.